Welcome to Talk Tickers. You're looking for the key takeaways from today's big earnings calls, and that's exactly what we deliver.
Yep, straight to the point.
Today, we're diving deep into the Blackstone Q1 2025 investor call.
A big one.
Our mission, as always, is to unpack the crucial financial results, these strategic moves, and management's take on the current economic landscape.
Also, you get up to speed fast.
Exactly. So let's jump right in. What did the top line numbers look like for Blackstone this quarter?
Well, they had a pretty strong start to the year. Distributable earnings hit $1.4 billion.
Okay.
That's up 11% compared to last year.
Solid growth there.
Yeah. And on a per share basis, that works out to $1.19. They also declared a dividend, $1.93 per common share.
All right. Returning value to shareholders. What about flows? That's always a key metric.
Right. And this really stood out. Inflows for the quarter hit $62 billion.
62. Wow.
Yeah. It's the highest they've seen in 3 years.
That says a lot about investor confidence, doesn't it? Even in this environment.
Absolutely. And that huge influx pushed their total assets under management, their AUM, to a record high, almost $1.2 trillion.
Incredible. $1.2 trillion. What was the year-over-year growth on that?
That's a solid 10% increase year over year.
Okay.
And even their fee-related earnings, a key indicator of their core profitability, they grew too, up 9% to $1.3 billion.
Okay, so it's a strong quarter pretty much across the board. Let's dig a bit deeper now. What's driving these numbers? And maybe more importantly, what's Blackstone seeing ahead? How are they feeling about the market?
Well, when it comes to the market outlook, management definitely acknowledged things are more complex. There's increased uncertainty, largely because of, tariffs.
Right. Tariffs are definitely the hot topic.
Yeah. They made it pretty clear it's still early days to really understand the full consequences. I mean, you've got these intricate international trade negotiations happening.
Very complex. But beyond that specific uncertainty, what's their underlying view on the economy's health?
They actually see the fundamental economy as pretty sound, driven by, increasing productivity and a lot of technological innovation happening.
Okay, so some positive drivers.
But they did emphasize that getting a swift resolution to the tariff situation is pretty vital if we want to see sustained economic growth. Uncertainty isn't great for markets generally.
No, definitely not. So how does a massive firm like Blackstone, with investments everywhere, position itself to navigate these, let's say, choppy waters?
Yeah, this is where their model really comes into play. Blackstone stresses the stability they get from their long-term committed capital and their perpetual strategies.
Those are the funds without the usual redemption pressures.
Exactly. It lets them be patient, be strategic sellers, not forced sellers. And clearly, their investors, their LPs, value this. They've entrusted them with a huge amount of what they call dry powder.
Ah, yes, the dry powder. How much are we talking about?
$177 billion.
Wow. That's quite a war chest ready to deploy. So thinking about those tariffs again, what's the direct impact they actually foresee on their, vast portfolio?
Overall, they think the direct first-order impact from the announced tariffs is pretty limited across the board.
Okay.
However, they did flag a potential, maybe material impact on a small group of their real estate companies.
Interesting. How so?
They think tariffs could push up construction costs in real estate.
Which maybe counterintuitively they see as potentially good for existing property values. How does that work?
Well, the thinking is if construction gets more expensive, you'll likely see even less new building.
Makes sense.
And given that new construction starts, especially for things like logistics centers and apartments in the U.S., are already at their lowest levels in over a decade.
Right.
This extra constraint on new supply could actually support the value of existing real estate. Assuming, of course, we don't hit a major recession.
Fascinating dynamic, almost a silver lining, potentially. They also mentioned something about currency movements, didn't they?
Yeah, that's another point. The strengthening of some foreign currencies against the U.S. dollar is actually a net positive for many of their international funds. It boosts returns when they translate back into dollars.
Okay. So let's pivot then. How are they actually putting that capital, that $177 billion, to work right now?
Yeah, good question. In Q1, they invested $36 billion and committed another $13 billion to new deals.
So still active deployers.
Very active. Their main focus is on sectors where they see these strong long-term growth trends. what they call secular tailwinds. They kind of view this market volatility as maybe a good time to capture value.
Opportunistic. Any specific areas they highlighted as high conviction?
Absolutely. They're particularly keen on digital infrastructure, the data centers, communication towers, that sort of thing.
Yeah, that's a big theme everywhere.
Definitely. Also energy and power, life sciences, and they do expect a recovery in commercial real estate, maybe more longer term. Geographically, they mentioned India and Japan as having significant potential.
Okay. And are they selling much in this environment?
They suggested near-term sales are probably less likely given the uncertainty. But, that could change pretty quickly if market conditions get better.
Right. Flexibility is key. Now, another huge part of the Blackstone story recently has been their growth in private wealth, right? Selling to individual investors.
Oh, absolutely huge.
Yeah.
That channel now manages over $270 billion.
$270 billion. What percentage of their total AUM is that?
It's nearly a quarter of the entire firm's assets now.
Wow.
And fundraising there was really strong in Q1, up almost 40% year over year.
40%. That's massive growth. Which specific products are driving that?
Well, their big real estate fund for individuals, Bright, brought in almost $4 billion.
Okay.
Their private equity strategy, BXPE, raised $2.5 billion. A newer income-focused one, BXINF, had a really strong start, $1.6 billion. And Beer, their energy transition one, also continued to do well.
They seem to be rolling out new options there constantly.
They are. And looking ahead, they're launching another one, a fifth perpetual flagship called BMX. That's coming May 1st.
What's the focus for BMX?
It's aimed at the RIA channel, registered investment advisors. It'll be a diversified credit strategy. And importantly, it'll have a ticker symbol and daily subscriptions, making it easier to access.
Making it feel more like a public market investment in terms of access. Interesting. And they've also formed some partnerships to boost that reach, haven't they?
Yeah, quite significant ones. They announced a strategic alliance with Wellington and Vanguard. Big names.
Huge names. What's the goal there?
The idea is to collaborate on creating integrated investment solutions, ones that blend public and private market stuff, specifically designed for individual investors, making it simpler, more holistic.
That really could be a game changer for how individuals access alternatives. Okay, let's shift gears again to another absolute powerhouse for Blackstone, private credit.
Yeah, they're just dominant here. Blackstone now has the world's largest third-party focused credit business. We're talking $465 billion in AUM.
465 billion, just staggering numbers. How are the inflows there?
Over the last 12 months, the combined credit platform pulled in $113 billion.
Wow.
And a really notable area within that is their investment grade private credit business. That's grown 35% year over year to $117 billion. And that's focused on, financing the real economy, big companies.
They mentioned some pretty large deals they structured, didn't they?
They did. They highlighted a $5 billion solution for Rogers Communications and a $3.5 billion one for EQT Corp. These really showcase how they can create these bespoke financing packages without using their own balance sheet.
Leveraging their platform.
Exactly. And get this, since the start of last year, they've originated $55 billion of these private investment grade credits, average rating A-.
Solid ratings. And the attraction there is the yield.
Yeah, they're generating nearly 200 basis points, so almost 2% of excess spread compared to what you'd get in the public markets for similar quality credit. That's very attractive.
Very compelling, especially for institutions like insurers. And speaking of insurance.
Right, their insurance AUM is also growing nicely, up 18% year over year to $237 billion. That shows the strength of their open architecture multi-client model there.
Okay, so private wealth and credit are clearly huge engines. What other areas jumped out from the call?
Well, their infrastructure business is doing really well. AUM there is up 36% year over year to $60 billion, and performance has been strong.
Infrastructure is definitely another hot area.
It is. And their multi-asset investing arm, BXMA, that generated its 20th straight quarter of positive composite performance. So remarkable consistency there.
20 straight quarters. Impressive.
Yeah, and they also had a string of successful final fund closings. A big Euro billion European real estate fund, nearly $8 billion for a real estate credit fund, a massive $21 billion global private equity fund.
Wow, $21 billion.
And a $5.5 billion private equity fund focused specifically on the energy transition. Plus, they held a first close of $4.4 billion for a new Asia-focused private equity fund.
So just tremendous fundraising momentum across the board, really, globally and across asset classes. Let's circle back quickly to the core financials again. Fees, earnings.
Right. Management fees hit a record $1.9 billion in Q1, up 11%.
Okay.
Fee-related earnings, as we mentioned, rose 9% to $1.3 billion. Distributable earnings also up 11% year over year to $1.4 billion.
Solid growth. Anything else driving the earnings?
Yeah, there was a notable jump in principal investment income that was mainly driven by selling their bistro business to Clearwater Analytics.
Ah, a realization event. And what about potential future earnings, that accrued performance revenue metric?
Right. The net accrued performance revenue sitting on the balance sheet was at $6.4 billion at the end of the quarter. So a healthy pipeline there.
Definitely. And looking back over the last year?
Over the last 12 months, fee-related earnings hit a record $5.4 billion. That's up a strong 20% year over year. And importantly, investment returns were positive across all their major strategies in Q1. Infrastructure actually led the way, up 7.5% in the quarter.
Okay, so despite the macro uncertainty, the machine seems to be firing on all cylinders. They sound pretty confident about deploying capital then.
They do. They emphasize that these periods of market dislocation often create really good opportunities, not just in private deals, but sometimes in publicly traded securities too.
How so?
Well, they're seeing situations where the value of some public stocks might have gotten, disconnected from the company's underlying fundamentals, maybe due to technical selling pressure.
Yeah.
That can open the door for discussions about potentially taking companies private.
Right, playing offense when others are perhaps playing defense.
Exactly. And while they acknowledge overall M&A activity might slow down initially when uncertainty spikes, they pointed out how quickly that can change, like we saw back in 2020.
Good point.
Their core long-term conviction remains in those areas we talked about. Digital infrastructure, energy, life sciences, alternatives in general. That's driving their deployment strategy.
And they also spent some time talking about the resilience of the private markets model itself, didn't they? Especially in tougher times.
Absolutely. They really highlighted their asset-light balance sheet, minimal net debt, no insurance liabilities directly on their books. That's a key strength.
Gives them flexibility.
Huge flexibility. Plus, that massive dry powder allows for counter-cyclical investing, buying assets when they're cheaper, potentially. And their long-term investment horizon, their focus on actually improving the companies they own, that contributes to better outcomes over time.
And the long-duration funds help avoid forced selling, right?
Precisely. They aren't forced to sell assets at the bottom of the market just because investors want their money back immediately. It's a much more stable model.
What about their view on institutional investors, particularly in North America? Are they still allocating?
Yeah, they acknowledge that the North American institutional market is, mature, and it's facing some headwinds right now related to getting cash back from previous investments, the DPI or distributions to paid-in capital issue.
Right. LPs want to see cash back before committing too much more sometimes.
Exactly. But Blackstone's view is that these institutions remain deeply committed to private markets for the long term. Certain areas, like secondaries and infrastructure, are actually seeing increased interest right now.
And private credit, too.
Yes, interestingly, they're seeing growing interest from pension funds in investment-grade private credit specifically. So overall, they expect that trend of capital migrating towards alternatives to continue, simply because of the potential for better performance.
Okay. And the global wealth channel seems key to capturing that broader shift.
It really does. Their core belief is that individual investors want the same things institutions do. Better diversification, the potential for higher returns. And that alliance with Wellington and Vanguard is all about making that happen, creating easier ways for individuals to get that blend of public and private exposure, enhancing returns and diversification in a simpler package.
Okay, one last area, their direct lending business. How's that holding up with market volatility?
They said it's continued to get deals done, even with the recent choppiness, and pricing has remained relatively stable, which is interesting.
So demand for that capital is still there?
Yeah. They strongly believe private credit will continue to be a really important source of funding for private equity buyouts and other deals. That's a pretty substantive difference from past market cycles where banks might have pulled back more sharply.
What's the key advantage they see for private credit now?
Certainty. The certainty of the cost of capital and, maybe more importantly, the certainty of its availability. That's a huge differentiator compared to relying solely on potentially volatile public debt markets or bank lending.
Got it. Okay, that covers a lot of ground on the Blackstone call. Let's switch gears slightly. This is not financial advice.
Definitely not.
Okay.
Let's brainstorm a bit. Thinking about that huge push by Blackstone into investment-grade private credit.
Yeah, that $117 billion and growing fast.
Right. And at the same time, you hear chatter about banks maybe facing tighter capital rules down the line, which could maybe constrain their lending a bit.
Right.
So here's an outrageous but plausible idea.
Okay, let's hear it.
What about taking a long position in a basket of, say, insurance companies? Specifically, insurers known to be big allocators to Blackstone's private IG credit funds.
Interesting. What's the thesis?
The idea is these insurers could generate significantly better yields from that private credit compared to just buying public bonds. Higher yield could mean higher profits, potentially boosting their stock valuations. Meanwhile, Blackstone benefits from more fee-generating AUM, sort of a play on that structural shift towards private credit and that symbiotic relationship.
A second-order play on Blackstone's success in that area. I like it. Intriguing.
Okay, here's another one for you. Blackstone mentioned successful fundraising in European real estate, right? Despite the headwinds.
Yep, that $10 billion fund closing.
And they also talked about how tariffs could increase construction costs, which might possibly support the value of existing real estate in Europe again, assuming no major recession.
Okay, following you.
So what about this? Go long on some publicly traded construction materials companies that have big operations in Europe. Maybe hedge it with a short position in, say, U.S.-focused residential REITs.
Explain the hedge part.
Well, the long side capitalizes on potentially higher demand for materials in Europe if new builds become relatively more expensive there. The short U.S. REITs position hedges against potential headwinds in the U.S. housing market, maybe from different factors like those same tariff-driven cost increases hitting U.S. builders harder or other domestic issues. It's a relative value play based on those potential tariff impacts.
Trying to play the regional differences driven by those cost dynamics, okay, definitely fits the outrageous but plausible category. Some really creative thinking there.
Just food for thought.
Absolutely. And that brings us towards the end of our deep dive into the Blackstone Q1 2025 earnings call.
We covered a lot. Key results, strategic direction, management's view.
Yep, hopefully giving everyone a much clearer understanding of what's driving this industry giant. Remember, our goal here is just to provide valuable information, help you stay informed.
So what stood out most to you? It's worth thinking about the implications of all this.
Definitely. And as always, that this is not financial advice. This segment is purely for discussion, for sparking ideas. It is absolutely not a recommendation.
Please do your own homework. Conduct your own thorough research before making any investment decisions. Talk to a professional.
Couldn't agree more. Join us next time on Talk Tickers for another insightful exploration of the financial landscape.